Thought Leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today's episode is the next installment of our year-end toolkit series, which covers a range of topics designed to help you through the year-end reporting process. And don't worry, even if December 31 is not your year-end, or you're not directly involved in reporting, this 8-episode series has something for everyone. In this episode, we're focused on reminders about the audit process, which of course plays a key role in year-end accounting and reporting. With a lot of standard setting and rulemaking in this space from the PCAOB, we often get the question from preparers, how will we be affected? Today's episode will answer those questions for you.
So obviously, new or amended accounting standards, you've rattled off a couple, and they can significantly impact companies' accounting policies, their financial reporting, and their processes and controls. So it probably comes as no surprise that we find as these changes occur that robust documentation, analysis, consideration of alternatives, in the judgments and assumptions are really important relative to getting it right from a financial reporting perspective, including the notes to the financial statements. And we do find that thoughtful documentation promotes quality of the judgments and gets to better outcomes. And without that communication and documentation, it's easy to end up in a situation where issues remain either unresolved or perhaps need to be revisited late in the financial reporting process. And obviously, that's not good for anyone and can distract from other aspects of getting it right from a quality perspective.
That was Brian Croteau, PwC's U.S. Chief Auditor. And of course, if you've been following along with our year-end series, you know that our guest host is Kyle Moffett, PwC's National Office Professional Practice Group Leader. With that, let's tune in to the episode.
Brian, really happy to have you here today, joining me to talk about audit reminders, year-end audit reminders. And I think the way that I like to kick this one off is really highlighting hey, this is not just important for auditors. This podcast is intended really to help preparers as well. Think about the impact of the audit and how they can help with the audit process. And obviously, you and I together worked years ago. You worked, multiple times at the SEC, but in your time, you and I worked closely together on a number of different matters over the years. Obviously, you were in the agency's Office of Chief Accountant, and I was in the Division of Corporation Finance. And of course, kind of our current roles today, the amount of time that we spend with each other talking about a lot of these issues. I think as I think about kind of this, the entire year, what we've seen from the PCAOB, what we've seen from the SEC, obviously post-election, a lot of changes that we expect in the coming next few years. You and I attended the AICPA conference this week, and it was it's a long week. It's Monday through Wednesday of a lot of content. You spoke on a panel about PCAOB standard setting, and I think a lot of the audience found it incredibly insightful, and I think realized how impactful it was to them, even as preparers. And so we heard from a lot of different people. We heard from the SEC, PCAOB, the FASB, a representative from Congress, the chamber, preparers and auditors. Any key takeaways that you want to highlight from the conference?
Yeah, sure, Kyle. And thanks for having me. I think you're right. There's a ton to talk about here. It's not just for auditors, it's for preparers too. And look, as you know, the conference covered a wide range of topics, including regulatory changes, changes in the accounting profession, various accounting and reporting matters, updates from the FASB and the PCAOB, discussions on technology, sustainability reporting, but maybe a couple of themes that seemed to, they were of interest to me and I think really garnered a lot of attention at the conference. The first related to potential regulatory changes following the election results. And Congressman French Hill and SEC Commissioner Mark Ueda certainly got a lot of attention as they provided some of their thoughts at the conference, really talking about changes that could come about as a result of the new administration. So, they talked about a range of things, certainly potential regulatory rollback in the areas of digital asset and climate regulation, There was discussion about the assessment of the effectiveness of the PCAOB and exploring various possibilities of what could happen next, all the way from folding it or aspects of its functions under the SEC, or streamlining other aspects of its processes. I also thought the remarks on from Congressman Hill on putting in some safeguards and guardrails around cost-benefit analysis that would apply to the SEC, PCAOB, and others was very interesting to hear.
Absolutely.
Yeah. And then really an increased focus on capital formation, and then a potential decrease in compliance costs from what they've called excess regulation impacting investors. So really, I think that those remarks really garnered a lot of attention.
Yeah, one of the things that, as I talked to a lot of folks that were at the conference, whether they were speakers or attendees, really was the political undertone. And I think the more and more we move on in our profession and continue advancing the profession, obviously there's a lot of players that have interest in the work we do. So the post-election outlook, right? As you think about regulation, it obviously is all the talk. It's a lot of conversations I have with executives or boards, audit committees. I know you have the conversation probably more than anyone, or you and maybe Roz Brooks, talking about a lot of regulatory outlooks. And so as I think about kind of our period of time that we worked at the SEC, the various changes in administration, I think over the years, we saw it continue to evolve. And I think more and more we've seen that, we've seen the SEC and the PCAOB transition, leadership transitions. Obviously, you mentioned we're going to see a different approach. It sounds as though we'll also see a different approach with respect to enforcement based on things that Paul Atkins, who has been nominated to be the chair of the SEC, really has been talking about with respect to the enforcement. What's your thought on this? I mean, it seems like we might see a more principles-based approach. I think we'll see maybe the same numbers of enforcement actions, but maybe what they focus on, the bases of the actions might be different. Certainly would expect to see maybe them focus more on individuals, which I think Atkins is supportive of, and maybe less so on companies, or at least being a little bit softer on that. And any reaction to that? Yeah,
look, Kyle, I mean, I think we can all speculate, and for sure there'll be a good amount of change. There always is when there's change in administration, and particularly this time, I think we can expect a good amount of reevaluation, rethinking, and changing, and in this case, probably what some would view as rationalization of existing policies, rules, and the like. I would just make the point, though, that, look, in the end, quality, whether you talk about audit quality or reliable financial reporting, is bipartisan. And I think it's really important that, notwithstanding all what could be distraction around change that may be coming, that we focus on what's in front of us, and we really focus on the need to maintain quality in the current environment. There's a lot of new rules, and standards, both from an accounting and auditing perspective, and guidance that's been issued that we need to follow in the meantime, and that we need to stay focused on. So we'll all follow closely, and we'll also obviously be looking to consider the implications of it and making change where change is appropriate. And maybe, Kyle, just pointing out, Wes Bricker, who's obviously our global assurance leader, emphasized something that I think is really important. He kicked off the conference, as you know, and he really emphasized the accounting profession's role in building trust, reducing information asymmetry, and enhancing investor confidence. And I think that's paramount. So he also emphasized the value proposition of the profession, really including the tangible outcomes such as reducing fraud, lower costs of capital, and the tangible benefits of building long-term trust in the capital markets. And so, I think there's a lot of high road here, and there's a lot of room for common ground relative to the importance of quality and trust in reliable financial reporting.
No, I think those are great points. And, obviously we did see some attention to Wes's comments and obviously some attention by, some members of the PCAOB or board members of the PCAOB. So obviously I think that it certainly is, all those points are very relevant. One of the things that we saw at kind of after all of that and kind of hearing Paul Munter. So Paul Munter is the SEC's chief accountant, still in place. There's questions of whether Paul will remain in that role, but he is and will remain until something happens. He highlighted a lot of those messages, right? And I think quality is their focus, and Their remit is obviously oversight of the PCAOB. So it really highlights the important role the profession plays in serving the public interest, in protecting investors. It also emphasized a lot, and I heard this a lot, and I think we heard it a lot. We continue to hear it a lot, which I think is great for the profession, is the focus, the importance of ethical behavior, and really encouraging accountants in the audience to, this is not just at the conference, but as speeches over the years as well, to ensure kind of the credibility and reliability in financial reporting. And obviously ethics is a big piece of that.
Yeah, I couldn't agree with all that more, Kyle. And maybe another theme that I'll highlight is the need for broad stakeholder engagement in regulation and standard setting. I think that was a big theme too. Quality financial reporting really does require cooperative efforts, and that's among standard setters, regulatory bodies, investors, preparers, auditors, academics, and really constructive engagement by everyone in the process from a financial reporting ecosystem perspective. It's really necessary to address the challenges that we have and to improve practices over time. So, the other thing I'll mention maybe is, stakeholders discuss various, kind of more detailed accounting, financial reporting, auditing, and regulatory topics at the conference. We don't have time to get into all those, but, if you're interested in that, certainly you could refer to the publication that we put out on the highlights of the conference. But really a lot when you get into the details of the things, again, back to what we have before us today to work together on to get right in the meantime.
I love how you framed it as work together. And I think that's the message that, as you think about the connection between the preparers and the auditors and thinking about the audit committee and their role, that I think that's a key point. You mentioned the in-depth. I do want to refer some folks to some of our previous podcasts on a number of topics, and one of them was an accounting podcast where we had our deputy chief accountants talk about a number of different topics. And clearly there are a number of external factors such as changes in accounting standards, regulatory developments, or macroeconomic events. And you could talk about the impacts on MD&A. And of course, we get into that on other podcasts. And, really they could really warrant that reevaluation of accounting policies and controls and, changes to various agreements or, the restructuring of debt or, just modifications. For me, though, I think Pillar 2, segmented reporting and revenue accounting, those continue to be the area of focus every year, not just at the conference, in comment letters. So, it's top of mind. What other topics, though, are you focused on specifically? What should preparers keep in mind when considering all the impact of all these types of developments?
Yeah, sure. And as you know, there's really a lot to focus on here for preparers and auditors as we close out the financial reporting cycle. So obviously, newer amended accounting standards, you've rattled off a couple, and they can significantly impact companies' accounting policies, their financial reporting, and their processes and controls. So it probably comes as no surprise that we find as these changes occur that robust documentation, analysis, consideration of alternatives, and the judgments and assumptions are really important relative to getting it right from a financial reporting perspective, including the notes to the financial statements. And we do find that thoughtful documentation promotes quality of the judgments and gets to better outcomes. And without that communication and documentation, it's easy to end up in a situation where issues remain either unresolved or perhaps need to be revisited late in the financial reporting process. And obviously, that's not good for anyone and can distract from other aspects of getting it right from a quality perspective.
And may delay your reporting as well. And that's
good point.
Even further impacts, right?
For sure, it has that potential as well. And so look, in our experience, when there's robust documentation, there's lower likelihood of errors, there's lower likelihood of control deficiencies, and as you said, less likelihood of delay. You mentioned a couple specific areas. So Pillar 2 and segment reporting, for example, there are a few matters that come to mind. And certainly this isn't an exhaustive list, but with Pillar 2, let me just say, even in cases where the current year tax impacts aren't expected to be material, it's still necessary to establish the new processes and systems to capture the underlying data and perform the computations, because this is going to set the foundation for the future. Mm-hmm. And as additional countries come on board, the impact may become material. Preparers should also keep in mind that even if they're eligible for and rely on the new transitional safe harbor, it's important to note the safe harbor might not always apply. the underlying data really does remain important. And as I mentioned, it'll be used to test in the future on a country-by-country basis. So really important to get the right initial base set up there from that perspective.
Yeah, and look, there's a lot of consequences, right, to this, and it's not just your reporting. It's also the disclosure. How you're thinking about MD&A disclosures. One thing I do want to kind of mention is we will have a podcast available with respect to tax accounting and reminders for year end. So Jen Spang will be joining me and I think cover a lot of topics. Obviously, Pillar 2 is going to be that the focus there.
I know that'll be a great discussion. I know I always learn something when I listen to Jen Spang.
Absolutely.
Okay, so for segment reporting, Kyle, let me just mention it's critical to evaluate not only what the CODM regularly reviews, of course, but what's provided to them or could be recomputed from other information. So I know gross margins, the example we always kick around, is just a good example where if the CODM reviews gross margin but doesn't receive cost of goods sold, companies have to determine whether that's easily recomputable, of course. And if it is, it could meet the significant threshold, even though that specific line item might not be presented. So I think that's another area to be focused on. You mentioned revenue recognition, and we spent a lot of time from an audit perspective, obviously, as we assess the accounting for contracts and contract modifications. In most cases, any consideration that's exchanged at the time of a modification of a contract won't be recognized immediately, but it'll be attributed to the ongoing arrangement. In particular, contract modifications that reduce the scope have to really be carefully evaluated. Another topic that comes to mind is commercial real estate and other liquid assets. And the PCAOB actually did issue a spotlight on this earlier this year, which has been an ongoing topic of discussion with our engagement team. The spotlight, I think, rightfully highlights how the valuation of these assets can be impacted by refinancing risk and the higher interest rates and declining values in refinancing risk. So I think there's something like 20 or 22 examples in the auditors can think about as they're working through their audit work in this area. So whether it's for CRE or other liquid assets such as private equity or private credit, including where these asset categories are present in company-sponsored pension plans, determining the values might be complex.
That's a great point. Yeah, that's a great point. And that's the thing that we know the staff at the SEC and their comment letters, they've been issuing a lot of comments on commercial real estate and the exposure. And I think, in our experience at the SEC, right, we're always looking a little harder when you're thinking about valuation and thinking about the use of specialists. And so the impacts there. And obviously you mentioned, documentation and the importance of documentation earlier in other topics. But again, here, I think that the disclosures are critical. And so you think about critical accounting estimates. Are there any impacts there? And I think it evolves, right? You revisit it every single year. Those disclosures and critical accounting estimates. So I think very, very important highlights there.
That's exactly right. Yep. So we're also carefully assessing the impact of relatively high interest rates, although lower than previous, still higher than probably a lot of initial debt, particularly combined with empirical data suggesting that higher rates of default on debt and there's a greater need for assessing going concern assumptions. And so from an audit perspective, we're really focused on this. Obviously, that's more applicable in some circumstances than others, but again, it's where communication and documentation is really key. And it's important that management and audit teams have a clear and comprehensive understanding of the financing plans, the projected cash flows, and really understanding the feasibility of these plans. The treasury function at companies should obviously be involved in these discussions, but these discussions, the earlier you have these, obviously, the better where they're relevant, because these are another example of an area that you don't want to be handling at the end of the financial reporting cycle.
Yeah, absolutely. It's the other thing that you kind of think about with respect to those types of disclosures is it's not a kind of a one and done, right? You really have to be thinking about this kind of every period, right? Every quarter. Right. Yep. And certainly the current business environment does require companies to be increasingly dynamic. And so there should be changes to operations, newer revised business arrangements. We talked a little bit about that previously. Leadership shifts, right? Or changes in maybe who the CEO is or even the reporting that they're getting and how that impacts kind of not just the accounting, but reporting. Newer discontinued products and services, which we certainly see a lot of, talked about them on other podcasts as well. in these instances, preparers do need to really reassess their previous accounting models. It's not a static. They need to be thinking about the impacts. And I can tell you as a reviewer of filings, if there was something material, and material meaning it was disclosed, if I saw something was disclosed and I saw changes, considering the current facts and circumstances, you're going to take a step back and look and understand, are there changes in accounting that need to be reflected? And so you have to always revisit it. And we really important to maintain that transparent communication and sharing of documentation with the auditor throughout the process. And I always hear you say that. And I think it's not just the message for our auditors, which we hear a lot in our own internal sessions, but it's the messaging to companies is that's really like key. And it's key evidence that auditors obviously need, but its companies will benefit from that. And so throughout the process, it's really engaging and keeping the auditors in the loop. So are there other considerations to keep in mind? Any sleeper issues or?
Well, look, I think you've said it all really well. Importantly, you wouldn't want to, just wait for your auditor to be asking you these questions. These are questions you want to be thinking about on your own and evidencing to your auditor that you have a process to think about whether there have been changes and have you addressed them? Have you thought about your controls around them? And for example, are you implementing new controls over a growing revenue stream or controls over the identification of and accounting for internal use software and cloud platforms, for example, or controls over that are specific to non-controlling interest in investment arrangements.
Mm-hmm.
The things that are changing within your company. Have you really stepped back and thought about where do I need to evolve my controls, and not waiting and having just to try to evidence that for your auditor at the time of the audit?
Yeah. So along with a lot of these changes that, as we've mentioned, often comes the execution or modification, which I think is a bit of one that people kind of sneaks up on people, of significant agreements and contracts, and really does introduce complexity to the accounting and the reporting, and obviously the auditing there. And I think certainly we talked about the delays that could be caused as well. So as we think about prior podcasts that we've done, we have addressed some of the accounting consequences that should be considered. But what else do you think that preparers should keep in mind as they execute?
Yeah, look, Kyle, and at risk of repeating things from other podcasts, as you said, evaluating significant contracts and agreements can be an area of complexity. And it is really important for companies to thoroughly consider any accounting impacts of modifications to revenue, leases, debt, or equity instruments. Engaging with the accounting group within the company and your auditor prior to signing can really help identify key terms that might have an adverse accounting consequence. And for example, equity instruments can have a particularly complex outcome, and there could be instances where the modification could result in an equity instrument being reclassified as a liability instrument. So as always, consider controls. You want to think about particularly for evaluating, executing, and retaining the documentation, the key considerations related to new contracts or contract modifications. And revenue contracts are an area I wanted to pause on in particular, Kyle. Really, anytime there are modifications to revenue contracts, or even beginning to sell new product or transact with a customer in a new way under existing contracts, preparers really need to focus on making sure they've got processes to evaluate and monitor the potential impacts and the effect that it may have on their revenue recognition model, including with respect to our evaluation of the completeness of the evaluation of performance obligations, which, some of which may not become operative until subsequent years. As auditors, we really are looking to understand if the processes associated with these controls are executed and documented consistently and comprehensively. And so the assessment or the reassessment where there's modifications is key for each reporting period, including quarterly, really to reduce the potential of material change in accounting later in a later financial statement. So really important area, Kyle, and I think one that deserves some doubling down of attention.
I'm glad you mentioned that, because I think we talked a little bit about this, or at least kind of the accounting consequence of this for under revenue, and we do have a podcast for that as well. We didn't necessarily spend as much time, to your point, about kind of thinking about the documentation and all of the considerations there. So I think that's very helpful. In kind of thinking about like a lot of what we hear you say quite often is completeness and accuracy, and so and I think that when you talk about the financial statements, a lot of our audience is listening right now, and they're in the process or will be in the process of preparing financial statements and their disclosures. What are some reminders for preparers to be focused on to achieve complete and accurate disclosures within the financial statements?
Yeah, that's great, Kyle. So we are very focused, of course, on understanding and assessing the company's process and controls for annual reporting, including those related to the disclosures, which, some of those often only occur once per year or perhaps quarterly in some cases. And this means breaking down these controls is important, and it can become challenging to address for both preparers and auditors. And one really important point in practice we've noted is for preparers to have controls that are specifically designed to determine whether there's any inconsistent, omitted, or contradictory information in the financial statements. And the controls that are specifically designed to determine whether the appropriate disclosures have been made are really critical. In other words, it's not just ticking and tying the numbers in your notes. It's really, determining that the notes are appropriate and that they're internally consistent, and thinking about the descriptions provided and whether they provide the whole picture. So there's a lot to think about relative to disclosure controls. And, these are matters that we also assess as part of our evaluation of the fair presentation of the financial statements. So having, consistently executed controls that achieve the objective really help improve the financial reporting and audit experience. As disclosures and amounts reported and filings change, preparers need to reevaluate the level at which the controls or control activities operate. Obviously, controls can become more important as materiality changes. And we also find sometimes that financial statement controls, particularly in the notes, can be aggregated at too high a level when there may be a very important difference for certain control activities, or having broken out controls into multiple controls, where, for instance, the controls over a tax footnote or leases might be different than those over fixed assets
Right.
or inventory, just given the increased complexity. And similar to what we've discussed, in executing these controls, you really do want to focus, as you've mentioned, on accuracy, completeness, and all the points that I've mentioned. So it's an area for obviously ongoing focus.
Yeah, no, it's a little bit overwhelming for some preparers as they're really thinking about it. I mean, obviously, most financial statement preparers are always thinking about internal controls over financial reporting. But one of the things I think that you kind of have intertwined or woven into this conversation is kind of the importance of disclosure controls, right? And so I think of also disclosure controls and procedures that apply broadly to the entire document that's being filed with the SEC. Internal accounting control provisions that have been around for years and years and years, books and records provisions. So there's a lot to think about, right?
Yeah.
That it's not just a financial statement focused thing.
Yeah, you're speaking my language now. And obviously, we've been talking a lot about the financial statements and ICFR controls. Important to keep in mind your disclosure controls and procedures. And importantly there, information communication, making sure information is bubbling, surfacing to the top, that is being considered by the disclosure committee. That's one of the things from time to time we see that important information exists within the company that doesn't get considered at the right levels to make sure that the appropriate disclosures are made, whether those are financial statement disclosures or disclosures that need to be made in other parts of the filing or otherwise.
Cybersecurity is one of them,
There
right?
you go.
Right? So, yeah, you may have brainwashed me, Brian, about 10 years ago. So
I tried.
So look, I think one other sleeper issue is, and I say sleeper issue because we as auditors get it, we know it, right? And certainly there are things that you see that where there are violations and that happens. But I think the other piece is the preparers understanding their role, right? Or audit committee understanding their role in independence. And it's really fundamental to what we do as auditors.
Yeah.
It always warrants some mention. My experience, companies are often making changes in advance of or shortly after year end, and they can make many changes, right? Directors, officers, affiliates, maybe restructuring of their legal entities or things that potentially could impact. And so, what are the potential implications there of these changes if they're not timely communicated to the audit team?
Yeah. Well, Kyle, you probably remember back. I mean, we've dealt with a couple of these together probably when we were both at the SEC, and certainly I dealt with a lot of them as I used to administer the rules. And the worst case scenarios are scenarios where you had to communicate from the SEC that the company would need either a re-audit or change in auditors. Obviously, those circumstances were few and far between, thankfully. But it can be significant relative to implications. So, look, it's an area it's a shared responsibility. It requires management, auditors, audit committees to work together to make sure that there's ongoing communications making sure that information is being shared timely with auditors relative to potential changes. So when you think about changes in directors or affiliates or asset acquisitions or the hiring of a former, auditor employee, or changes to legal and tax and financial reporting groups within the company, all those kinds of things can have significant implications on how we assess our independence as auditors. So making sure that you communicate timely and in advance of some of these things occurring is critical to making sure timely evaluations are done and the right steps are taken to assure the ongoing independence of the auditor is really critical. So making sure this is something where there's a periodic touch point relative to all of these issues is really, really critical.
Yeah, no, that's definitely a best practice or a must practice, I'd say. So let's close out with a couple of areas that I know have really garnered a lot of interest in recent months for differing reasons. And this is something obviously that you've spent a lot of time talking about and thinking about. And it's starting us with this known or suspected fraud or illegal acts. The PCAOB did recently delay action on that noncompliance with laws and regulations standard that I think we obviously all agreed would have been a significant lift for audit firms, but also significantly impact companies, public companies. And so it still, though, gets a lot of interest from investors and other market participants. And so obviously, who knows, at least where the standard will go. I think there's a lot of views that it may not be something that is a focus of then maybe the next PCAOB leadership if there are changes there. As you reflect on all the conversations you've had on the topic, including your role on the Standards and Emerging Issues Advisory Group, a SEAG at the PCAOB, what would you highlight for preparers? Yep.
And since you've mentioned my role in the SEAG, I now have to give my disclaimer that none of my views today reflect the views of the SEAG or anyone at the PCAOB.
Right. Yep.
But and you're right, Kyle. I don't know what will be the fate of the proposed NOCLAR standard that was about to be finalized. But I do want to highlight that the PCAOB did issue, and I think it's good for management and auditors, did issue recently a publication last month in November, a spotlight on existing responsibilities for auditors. And I think it's important for management and auditors to step back and remind themselves of their own obligations and responsibilities relative to understanding and assessing fraud and illegal acts. And there's a lot of time that companies obviously spend today and auditors spend today. And I think that document actually does a nice job at helping lay out and remind people of all the things that happen in today's world relative to the existing standards and obligations. Because I did participate in March in the PCAOB's roundtable, and it became very clear that I think there was a lot of misunderstanding about all the good things that happen today.
I've watched that, and I agree, a lot of misunderstanding.
Yeah, and there was also misunderstanding as to what some investors were looking for, and many investors, at least at the roundtable, didn't even seem to be asking for some of what was proposed.
Right.
But anyway, I more recently participated in a roundtable of the AFC and CAQ Fraud Forum, where I discussed the responsibilities, and I pointed to COSO in Principle 8, and I think it's good for people to reflect on that and make sure that, is management doing an appropriate fraud risk assessment, and do they have the appropriate anti-fraud programs and controls in place? And I think making sure that the whistleblower hotlines are robust and have the right controls and protocols around them for completeness and evaluation. And oh, by the way, not just what comes in through whistleblower, but things that are reported to the company outside of those programs and hotlines. How are those assessed for completeness? And then obviously making sure there's the right communications with auditors around those matters. So, I think a lot to think about in terms of what companies do today and what auditors' existing roles are, roles and responsibilities are relative to the identification, detection, and addressing matters that are identified relative to noncompliance with laws and regulations.
So you talked a little bit about this of just as you think about kind of the misconception that maybe some of the panelists at that previous session that you had at the SEC talking about this topic specifically. And so we do know that there does continue to be concerns from some investors and the regulators, right? We've definitely heard that from the regulators, and we've been hearing that heavy emphasis on that over the last few years, that auditors really don't do the work to respond to suspected fraud or illegal acts in an appropriate or timely manner. Are there any other challenges in this regard to highlight?
Well, particularly for identified matters, I was sort of surprised that there's confusion around that. Obviously, it's important for firms like we do to have robust policies and procedures that are followed And there needs to be a full understanding of the facts and, of alleged fraud or illegal acts. And that may involve involving forensics specialists. It may involve investigations. Third parties may be involved in that, depending on the nature of the matter, and certainly communications with the audit committee. And there could be obviously implications to the financial statements, broader legal and regulatory issues. Could upset the timing of filings. So, I do expect auditors to be doing the right thing here, following these policies and procedures, regardless of when and how they learn of the potential matters in the audit cycle. And obviously, the sooner they're dealt with in the audit cycle, the better. But it's really important for management to raise the matters that they're dealing with on a timely basis so that they can be appropriately dealt with without holding up filings where it can be avoided. In some cases, just given the timing of when things might arise, it's sometimes not even possible. And the company needs to go through their processes. The audit committee needs to go through their processes. Investigations need to be completed, and then obviously the facts need to be dealt with. But the earlier that can be done, the better. But we see this all happen and play out time and time again when these types of things arise. And obviously there's not a lot of transparency unless ultimately there is disclosure that's appropriate or necessary, or in some cases restatements or other actions that companies take, which you do see from time to time. But for all the ones you see, there are others where the work has to be done, even though ultimately something's not substantiated or it doesn't have the financial reporting impact.
I love that point. So one more topic, Brian, and I know I've kept you for a while now, and it's been an exhausting week for us. We've both been traveling. AICPA conference definitely can wear you down. But I want to touch on AI, and it was talked about a little bit at the conference, but I think getting your perspective, I think, would be very useful here, at least for our preparers. I mean, any thoughts or reminders for preparers that are considering using AI? And I won't talk about the different, the AI and the generative AI, but as they're thinking about their financial reporting processes and the use of AI.
Yeah, well, this is a topic I could sit here with you for the rest of the day and talk about. It's one that's near and dear to my heart. We've been very focused on it. I had a weekly call this morning with my team. We do weekly calls on this from a policy perspective and really helping to try to advance.
That sounds amazing.
The things we're doing. Yes,
it sounds exciting.
It's one of my favorite calls of the week, to tell you the truth.
Yeah.
And really, I think there's a lot here. I mean, preparers at early stages here. So are we, as you think at least about generative AI, and we talk about responsibly embedding Gen AI in everything we do over time. Obviously, there's a lot to think about in making sure that we've got the right human involvement, that we're providing data sources, and there's reliability around that. So we've got policies and protocols in place from our perspectives. But when I think about companies, I think it's really important for companies to have the right governance around this, the right policies around this, and to make sure they know where within the organization AI may be being used. If you're using that to generate memos or to perform analyses, it's important to understand that you've begun to do that. When we use it, we're ensuring that we're doing it within the side of our firewalls and that the confidentiality of the data is maintained. But that's another important consideration. So there's a lot of unique risks here. We've spent a lot of time making inquiries of management, obtaining management rep letters, making sure we really understand where in the financial reporting process companies may be beginning to use AI. It's around, on Gen AI, it's around the margins. There are some situations where within controls we're seeing the beginning of the introduction of Gen AI with the right human involvement. So not to the point where we've certainly identified deficiencies in controls, because it tends to be almost additive or incremental with the human involvement around it. But there's a lot of opportunity here. I know there's a lot of interest in the future relative to what the potential use cases and all the things that can be done going forward. But I think rightfully companies and auditors are moving at a measured pace. I think we'll look back at this time frame someday and think that things were actually, while it feels fast now, we're probably moving very slowly compared to what we're eventually able to do in this space. But for now, we're watching it closely. We're engaging with management, and governance policies and thorough understanding of what's going on with your organization is the best advice I can give.
Brian, as we teed this off, we were talking about this focus on, this podcast on preparers. And I think I kind of wish that we could get that like really in front of the masses and have everyone hear that, because I think it really would help companies as they go through not just their audit season, but also like the review cycle, when they're actually filing their quarterly reports and the work the auditor does with review and the importance of assessing things throughout the year as well. So I really appreciate just everything that you've shared today. So Brian, thank you so much.
Thank you, Kyle. It's great to be here.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.